Okay, hello everyone. We can start our webinar. I'm very happy that you came, that you are here to learn about trading Forex. We have a webinar which will last 45 minutes to 1 hour. And on this webinar, I will tell you the basics about the market, what is Forex market, who are the market participants, what do you actually trade on this market, how to behave on it. And after this webinar, you will have a basic knowledge about the Forex. What is more, I would like to invite you now for the webinar on Friday, where we'll have more advanced course, a bit more knowledge about Forex. We will expand the topics that we are talking about today. So, of course, you would like to know a bit who is the teacher who is teaching, because in terms of trading the market, in terms of trading Forex, you would like to obtain the knowledge from a person who actually knows how to trade, and not only on a demo account, but on a real account. So I do have over 10 years experience in trading on real accounts. I did over 400, even not 500 webinars and seminars across the globe about trading. Sometimes I'm featured in the media talking about macroeconomy, inflation, GDP, in general, macroeconomy. And as a trader, I prefer to focus on price action. I'm a swing trader, which means that I keep my positions open for a few days to a few weeks even. And my strong focus is on money management and risk control and trading psychology. So without a further ado, let's go to the basics of the Forex market. So Forex itself, it is a shortcut from foreign exchange. So it is an exchange where you trade foreign currencies. So you trade currencies against each other on the global market, because in order to buy dollar, for example, you need to pay with other currency in order to buy dollar, right? So that's why on the Forex market, you trade currency pairs. So two currencies against each other. So it is the largest financial market in the world, with a daily turnover over $6 trillion. And it facilitates global trade and investment by enabling the currency conversion, which answers us a question straight away: who are the market participants? Who is actually trading on the market? Well, governments, big institutions, hedge funds, big banks. There is a group of retail traders, of course, like us. I hope that you will become a retail trader one day, a profitable retail trader one day. So everybody enters this market in order to exchange currencies, in order to buy dollars, sell euros, etc. Right? And this, thanks to this market, thanks that we have Forex market, we are able to do this. And for example, if you want to trade American stock exchange, right? You want to trade on Wall Street. You can trade on the platform, but trading is done on Wall Street, right? Those companies are listed on the New York Stock Exchange, where they can be traded. Where are listed currencies that are traded on the Forex exchange? Well, that's the thing. This market is decentralized, so there is no one exchange where you can trade currencies. There is no building in Amsterdam or I don't know Los Angeles where you buy dollars and sell euros, etc. So there is a market which is decentralized, and all those market participants are connected with each other by a network of connections, let's say, and you have clearing houses, there are brokerage houses, and inside of this network, you have, of course, systems which facilitates the global trade of currencies. So there is no one place where you trade currencies. You do it on the Forex market, which is decentralized. You have an access to this market via internet. And Forex market became so popular in the past several years because it became much easier to trade currencies. Before this, in order to trade currencies, you needed to have a lot of money in order to access the market. You didn't have a computer system to do this, so it was a hassle. It was really a problem to trade currencies. But with time and development of systems, and it allowed retail traders to enter the market, and now thousands, hundreds of thousands of traders around the globe are trading currencies on the Forex market, on the Forex platforms. Why to trade Forex? Well, as we said, it's a huge market, which means that it's a very liquid market, which means that there is a lot of money floating on the Forex market, which allows to have large trades without large price deviations. What does it mean? Well, if you trade on the stock exchange, you're probably aware that where you have smaller companies, it's really hard to sometimes enter the market, buy those shares, or for example, when that's the best example, when you have a recession and prices are going lower rapidly, a lot of people want to sell and not many people want to buy, and this creates a situation where it is really hard to find a buyer for the stock that you own. So you have to propose lower prices for the people to buy those shares from you, which means that the market is not liquid. There's no liquidity, so the price that you're getting is much worse. Forex market is very liquid, so the price that you're having is the best price that you can actually have, and it's really awesome. I mentioned also that you can have problems when selling during a recession. So that's the thing about the Forex market. There is no recession on the Forex market. Okay, you trade one currency against each other. So there is no, even if there is a, let's say, recession in Eurozone, and euro is losing value, then you trade euro to American dollar, so you buy American dollar against euro. Okay, there is no problem with that. You can trade both ways, buy or sell. On the stock market, you can also, in theory, sell, but the thing is that not every instrument you can short trade, not every instrument you can sell. On the Forex market, you can do this with every single instrument. And in general, stocks are climbing higher, indices are climbing higher. On the Forex market, there is no such a thing. Two currencies quoted against each other can go up or down, or up or down. It doesn't really matter. The thing is that on the Forex market, we do have a leverage. Why we do have a leverage on the Forex market? Well, if you take a look on the change of the value of the currencies every single day, they are really low. It is said that Forex market is really liquid, that a lot of it is liquid, but it's not volatile. It is said that Forex market is volatile, but it's not true. Forex market is not volatile. If you would see an average daily changes of euro to American dollar, it's around 0.5% every single day. If you will check, I don't know, American dollar to Japanese yen, it's also pretty much the same, 0.5% every day. Is that a big volatility? No, it's not a big volatility. So why people think that Forex market is volatile? And just to compare this, when stock can move 2%, 3% one direction without any news whatsoever, right? 2-3% up, 2-3% down, just a normal day for a stock. If the stock has important news, the stock can move 5 or 10%. And as we said, currencies can move, for example, 0.2%, 0.5% on a normal day. And when currency moves 1 or 2%, it means that something huge happened, like interest rate decision or GDP miss or a huge inflation report, etc. So that's the thing. When you have such low volatility on the Forex market, it would be really hard to earn money on such small moves, right? Because then you would buy $1,000 and you would sell it to euros and you would get 955 euros, and then you would earn on it, I don't know, 1 cent or 2 cents, right? It would make no sense. It would be really hard to make living out of this. So why Forex market is considered volatile? It's because of the leverage. Leverage allows you to control much bigger capital, a much bigger amount of money than you're actually having, which means that you can capitalize, you can use those small moves on the Forex market, because again, moves on the Forex market are really small, prices not moving a lot. And in order to make proper amount of money on those small moves, there is a leverage which allows you to control bigger position, because on $1,000 on such a small move, you would not make a lot of money. But if you control $100,000 and on such a small move, you are able to earn some decent money. But in order to control $100,000, you don't need to have it. You just need to have a leverage. Okay, and that's the thing on the Forex market. And as we said, traders can profit from both types of move: upswing, downswing, upswing, downswing. It doesn't matter. On the stock market, again, as I said, we can sell most of the stocks. Also, depending from the stock exchange. In US, you can sell, but in my local stock exchange in Poland, you cannot sell every single stock. I mean, short sell. So when you don't have it, you can sell. You have contracts for some stocks. That in this way you can go short on stocks. But in general, if you want to earn money on the stock exchange, you have to buy. So as we said, on the Forex market, we trade currencies against each other. But I have to mention also that on the Forex market, most of the platforms on the Prime quotes for sure, you can trade more than just currencies. So you can trade commodities like gold, silver, other precious metals like palladium. You can trade other metals like copper, for example, other commodities like oil, natural gas. On Prime quotes, you can also trade cryptocurrencies. You can trade, of course, Bitcoin, Ethereum, Doge, and others. Of course, indices, but also stocks. Also, stocks you can trade on our platform. So, in general, Forex market, yes, these are two currencies against each other, but we have to go beyond that, because on our platform, you can trade much, much more than just Forex market. But again, coming back to the Forex market, so you can trade two currencies against each other, and you have major currency pairs and you have minor exotic currency pairs. And as of the major currency pairs, you can consider their euro, dollar, British pound, Japanese yen, Swiss franc, Australian dollar, New Zealand dollar. And major pairs are mostly quoted against the dollar. So Australian dollar against American dollar, euro against American dollar. And the thing is that those pairs are very liquid. The price between the change between buy and sell price, the difference between the buy and sell price is really, really low. The difference, by the way, between those two prices is called a spread, and spread, let's say, is the real cost of opening a position. Okay, so when you buy with the higher price and you sell with the lower price. If it was other way around, you would just instantly make money, right? So you would buy with the lower, sell with the higher. So you just click and earn money. So it doesn't work like this. You buy with the higher, sell with the lower, and you have to overcome this spread in order to start making money. And with the major pairs, the spread is the lowest, um, because they are very, very liquid. So difference between buy and sell price is the lowest. When you go to exotic pairs, like for example, Polish zloty, what else? Mexican peso, um, any other currencies from developing markets, then the spread is much higher because the pair is less liquid. So I already told you that on the forex market there are two prices, right? With one price you buy, with the other price you sell. So in the currency pair, for example, this is British pound to American dollar. The first currency is the base currency. In this case, is British pound, and the second currency is the quote currency, and in this case is American dollar. And the price shows us how much of the quote currency is needed to purchase 1 unit of the base currency. So in this case, British pound is more 1 British pound is more valuable than American dollar, because in order to buy 1 British pound, you need $1.25. Okay. In an example of euro dollar, in order to buy, for example, €1, you need $1.20. And then you have the spread, is the difference between buy and bid and ask, or buy and sell price. The lower the spread is, the better, of course. What drives the forex market? Why prices actually move? Okay. Well, many people would like to know the exact answer for this question. Like, for example, the price is going lower, and they would like to know why the price is going down. I thought that the price will go up because of this and this and this reason, but the price, in fact, is going lower. So, what drives the price? Well, that's the thing. Many, many things drive the price. Too many. That's why you will never know if the price will go up or down for sure. You will never know this. Okay. So that's why you always need to protect yourself with stop loss orders, which will close your position if you made a bad trade, if you made a, let's say, bad assumption about the direction of the price movement, because there is so many factors influencing the price moves that you will never know for sure that the price will go up or down. So first of all, you have economic indicators, GDP growth, employment rates, inflation, and manufacturing output, etc., etc. Let me come back to that thought, because I told you that you will never know if the price will go up or down, and then you may ask me, okay, then how can I trade? How can I make a trade if I will never know if the price will go up or down? Trading in general is full of of paradoxes. So yes, the outcome of every single move is unknown. Okay, the price may easily go up or down, but in the long run, you can have an edge over the market thanks to the fact that the price is often moving in the patterns, prices following patterns, prices following trends, prices moving in trends, prices respecting supports and resistances, all those price action principles and then technical principles. And you can have an edge over the market if you find those those patterns. You will be able to identify them and go with those patterns. What it means is that trading is a game of not possibility, because everything is possible, but trading is a game of probability. So you trade a thing which is more probable than the other at one particular moment. And having an edge over the market means that you're gonna trade a situation which happens 60 out of 100 times. Okay. So what it means that you can trade it, and 60 out of 100 times you will make money on this pattern, on this trade, but you can never be sure if the next trade will be win or a lose. Even after 10 wins in a row, you cannot be sure if the next one will be a losing trade or winning trade. And if you think that it resembles something, yes, it's a toss of a coin. In the long run, if the coin is normal, it's not weighted on one side, 100 times the coin flip should give you 50-50, maybe 49 to 51, etc. But if the run is long enough, it will be more or less even, the coin flip. Okay, the same goes with, but the thing is that the next coin flip is unknown. Okay, so even if you had 10 tails in a row, 11 can be also a tail. It does not have to be a head. The same goes with trading. In the long run, if you have an edge over market, if you follow one particular setup and you know that it's a good setup, you will win 60 out of 100 times, and you can make money out of it. 60, 70, 80, depends what your edge is. But you never can be sure what will happen with the next trade. Why? Because there is so many drives, there's so many factors which influence the market, as we mentioned here. So we have political events apart from the macro data, policy changes, geopolitical tensions. We have market sentiment, traders' perceptions and reactions to news and global events. And you may ask yourself, okay, there is a pattern, and even every trader in the world, they know that there is this pattern. Why it does not always work? And the simple answer is that not always the same people enter one particular trade. So if I would like to make it simple, let's say that you can see a pattern. Let's call it a flag. That's a real pattern, by the way. And flag should result with a drop, let's say, with a downswing. And then normally it does. But 1 week ago, it was a similar flag on another instrument, and it was traded by Goldman Sachs, JP Morgan, and Bank of India. This time, we can see the same flag, very similar flag, but Goldman Sachs is not trading it, JP Morgan is not trading it, and Bank of India is not trading it, but it's traded by Bank of Emirates, and for example, Deutsche Bank. Okay, so the outcome of this particular pattern will be different because there are different market participants with different amount of money, and they do different things, and they enter in not precisely the same time as previously. So that's why it differs. When trading Forex, of course, you need to choose a good broker, and that's why we are seeing each other here, because you are interested with Prime Academy. And it's a good choice because broker needs to be regulated, broker needs to be safe, broker needs to take care of your funds, and this is all about Prime quotes. Also, you need access to a lot of instruments, and that's Prime quotes, because again, I told you can even trade cryptocurrencies. And also you need good trading conditions, so low commission, low spreads, profitable swaps, and everything you're going to find in Prime quotes. About trading strategies, I told you that a strategy, well, it means that you need an edge over the market. Edge means that you are having a strategy which in the long run, in the long term, is bringing more profitable trades than losing trades. Maybe not even that. Maybe it brings just 20% of profitable trades, but how you manage those profitable trades creates a situation where they earn 6 times more money than those losing trades. And you still will be profitable even if profitable trades are just 20% of the overall. Okay, so that's another thing. Traders mostly focus on this edge. They want to have this winning strategy. They want to have this strategy which makes money, of course, and I don't blame you. But you need to know that to have an edge here is not really such a difficult part of trading. It's really pretty easy to find a profitable strategy. What is the problem is money management, risk control is how do you stick to the rules, how you stick to the system, how you use this strategy. That's the problem. That's why you have to focus on the mind, on the psychology, on the money management, on the risk control. That is the key in trading. But if we are here to talk about strategies, so you can have strategies different, but they can differ from each other considering time frames. So, for example, day traders, they open position and close it within the same day. Okay, they don't keep positions overnight. Swing traders, as myself, you open a trade uh, one day and you can keep it for a few days. You can close it in 1 hour, but you can close it in 6 days, for example. Usually it is like this, that losing trades, they close very fast, the stop loss is activated really fast, and the winning trades, they last for longer. That's pretty common. And position trading, which is mostly seen on the stock market, you buy stocks and then you keep it for a long time, and then you can sell it after 1 year, for example. As I said, risk management is absolutely key because it protects you from bigger losses. So the thing is that you should always trade small. So the position sizing is important. In general, the rule of thumb is that you should not risk more than 2% of your capital per one trade. And if you're risking more than 2% per capita of your capital per one trade, it can lead to a disaster. Trading is a long-term game, is a marathon, not a sprint. So you will not get rich overnight. You should not aim to get rich overnight. It's a marathon. You eat with a small spoon. You risk 1%, 2% of capital per one trade, and it allows you to learn more, gain a lot of experience. If you will risk half of your capital per one trade, losing trade, and you're gone. Second losing trade, you're absolutely gone. Okay, simple as that. So give yourself chance, give yourself opportunity to gain experience and trade small, trade with small positions. Don't go too crazy on the market. Always use also stop loss orders, which will close your position on a loss, but when you're thinking about the position is no longer relevant. So, for example, you were thinking that the pair will go up, but the price is going lower. Close your position, escape from it, and then move on with your life, move on with your trading, open another position tomorrow, and look for profit there. Don't fight with the market. Why? Because again, I told you, the outcome of every single trade is unknown. It can bring loss, it can bring profits. There is absolutely no way how you can say if the next trade will be winner or a loser. That's why you need to protect yourself from a losing trade by having a stop loss. What now? You gain some basics of the forex market, and now what you should do? You should move on. you should move on with that. You should move yourself to the next level of knowledge of trading. And I advise you to go with Mark Douglas, publications of Mark Douglas. He wrote two amazing books about trading psychology, Trading in the Zone and The Disciplined Trader. The Disciplined Trader is the first one, the Trading in the Zone is the second one. They are by far the best books about trading, and some may say that the only books that you need. And just read them. If you think about trading professionally, you would like to read those books. Also, read Forex Factory and other websites. See the news which drive the prices on the market. Also, open a demo account in Prime Quotes, start trading, start learning, see how the market works, see how a platform works. That's just you gaining experience, and that's a very important part. Also, for sure, should join our Prime Academy Telegram channel, where I post trading occasions, trading signals, but also other knowledge there. Really, let me give you a link to this group. You can join it, you can be part of this group, you can ask questions on this group, and we can stay in touch. Here I will post it on the chat. Here is the link to our Prime Academy group. So if you have any questions, please ask on the chat. But if not, then I will just move on to the platform. And you can see this is my platform. This is my trading account and Prime Quotes. Currently, I have 3 open positions. One amazing long position on oil, which was actually I gave this is UK oil, and it's on Brent. UK oil is WTI. UK oil is Brent, and US oil is WTI, because WTI stands for West Texas Intermediate, and Texas for sure is in the US. So I have a position here, open here. Stop loss is already on break-even point, so stop loss already protects my trade. As you can see, it's over 10%, around 15% of profit in one trade. Pretty amazing. I will explain you this trade, why I open it a bit later, because I'm showing you platform that we're gonna talk about those basics in the real environment. So this is the trading platform. Here we have list of instruments. As you can see in Prime Quotes, we have stocks, we have currency pairs, and we have main currency pairs like Australian dollar to American dollar, exotic, like for example American dollar to Danish crown, or Africa or South Africa rand. Cryptocurrencies, you see Cardano, you see Bitcoin against Euro. For example, you can see Doge. And indices, also we have indices, some more stocks, and commodities like cocoa, coffee, cotton, wheat, and yes, those instruments you can trade. Then you have a navigator, where you can see your trading account. You can see also indicators. I have pivot points. It's pretty simple indicator, although it's not by default on the platform. I mean, on the MT5 it is by default. On MT4 no. But it's a bit, let's say, it's a simple, but at the same time pretty advanced concept. But nevertheless, in Navigator you have your trading robots, algorithms, etc., which you can add on the chart. Here you have a main window, main chart. On the bottom you have tabs with the instruments, and on the bottom you have toolbox with your opened positions, the price where the instrument, the price, the date of the opening, stop loss. As you can see, stop loss always is set. Stop loss, you should always have stop loss. Take profit, not necessarily. Take profit can come in time, but stop loss should be always set. You can have hundreds of charts here, I would say, and you switch between tabs to find the chart that you want. If I would, for example, like sugar, I click on the sugar with the right mouse click, chart window, and then by default, that's the chart that you get. You can see mine charts are like this. It's more or less in the prime quotes colors. You click on the right button here, and you can have a template like this, or you can change the colors by yourself, clicking properties, and all those colors you can change. Like for example, background you can make like this. It does not look good. Think about this, that you will spend hours in front of the screen, so make them good for your eyes. This is good because it does not bother your eyes for a long time. Whites are not good for a long time if you will look at the charts, because your eyes can get tired. Simple as that. Charts can be presented in a way of line, candles, or bars. I strongly advise you to use candles. As I mentioned also, the book here, Japanese Candlestick Charting Techniques by Steve Nissen. That's where you will learn about candles. Those candles is the way to present a chart. It's the best way to present a chart. I highly recommend you to learn candles because it will give you another edge over the market, and you will use them. Charts can be presented in a different time frame. So in this case, one candle tells us what happened during 1 hour of trading, because here you have time frames. H1 means 1 hour. So one candle shows you how the price changed during 1 hour. You can switch to H4, D1, and for example, D1 shows us what happened during 1 day of trading. So one candle shows you what happened during 1 hour of trading. So let me briefly explain you. Here, when the candle is red, it means that during the day the price went lower, which means that the last price of the day is lower than the first price of the day, pretty much. If the candle is blue, it means that during that particular day the price went higher. So opening price, first price of the day is lower, closing price, last price of the day is higher. Okay, and first price of the day and last price of the day, they create body. This thick part of the candle, that's a body. But you can also see that the price has wicks, those shadows here, thin parts of the candle from the top and from the bottom, and they have different length. So it shows you the maximum and the minimum price of the day. So of course, during the day, the price made opened and closed. But also in the meantime, during the day, it made a local low and a local high. And those are marked with wicks, with shadows. So that's candles, and you should know that they have meaning. Not every single candle has a meaning. Some of them are meaningless, but many candles, when they are shaped in a particular way, For example, they have long bottom tail and a small body on top. That's a hammer because it resembles hammer, and they have a meaning. They have a positive meaning. They are bullish, and they promote an upswing. So this you should know. How to trade, for example. So on the platform, you have a button here, which is one-click trading. It allows you to sell and buy with one click. And here you have volume. In this case, it's one lot. That's a standard position size for the market. If you want to know how big is one lot, for example, British pound, Australian dollar, you go to symbols here, and then you have everything, all the informations about this particular instrument. You have spread, you have stops level, you have contract size. One lot is 100,000 of British pounds. Okay, you have minimum volume, maximum volume. You can see that 30 lots is the maximum point. Swaps for going long, swaps for going short, and all those important numbers are specified here. And then you buy or sell. Of course, I will not click it. It's a real account, so I don't want to mess with it. Just to show you something. You can also open pending orders, which would be open when the price would get there. For example, click here, trading, and then sell limit order. And when you click it, it opens one lot of gold, but here sell limit. So if the price would get there, touch this order, and then would go lower, I would make money. If the price would go there, touch this price, this position would be open. And why it open one lot? Because here's one lot. If it would be half lot, it would open half lot. And as you can see, open positions are published here. There is this gray bar with your balance, equity, margin, free margin. Equity is your balance plus minus open trades. So in closed positions on my account, I have $13,000, but I have $2,000 of profits opened right now. If I would close them with this XXX, if I would close them, I would have $2,000 more. So that's the equity. So balance. So equity is balance plus minus open trades. Margin is the amount of money which is blocked for those trades, which is blocked for those positions. And free margin is the amount of money which still can be used to open trades. Okay, that's a free margin, amount of money which can be used to open trades. So I still can use $12,000 to open trades. And below this are pending orders, so those orders waiting for an activation, like for example this one. And I'm gonna close it. You see it disappeared here. Let me maybe tell you about this American dollar to Swiss franc, because it's a fresh trade that I opened. Why I opened this trade? So the trend, most recent trend here is bullish. Trend means that the price goes higher in general, because it was on bottom here and then went higher, and then we had a correction. And this yellow area is an area of importance for American dollar to Swiss franc, because it was a support, so it was helping the price to climb higher. Then after the breakout, it became resistance, so it was stopping the price from climbing higher. Then after the breakout, it became support again. So I bought here. Stop loss is here, as you can see, is below this low. It was almost activated here, but it wasn't. As you can see, my position is really small. It's just 1% of the capital that I have, so it's really, really small. I bought here, and I'm looking forward for this scenario marked with the green color. So price bouncing of this support like here and climbing significantly higher. And in case of a take profit, I would like to have take profit, for example, here, which means I'm allowing myself to lose $150, but I'm aiming to gain $600. I'm risking 14 pips in order to gain 55. So potential profits is almost over 3 times bigger than the potential loss, which means which gives me desirable risk to reward ratio. And in trading, that's something that you should focus on because once your average profit is bigger than the average loss, it gives you the freedom that you don't have to be right half of the time. Even you can make mistake half of the time, and you can still make money, which is pretty amazing. So, my friends, I would say that's it. 50 minutes of pure knowledge about trading, about the Forex market. I don't want to overdo it. I don't want to give you too much information because it makes no sense, really, especially that we are going to see each other on Friday. So, I hope you will join our second webinar where I will explain things in a greater detail. Hopefully, I will see you on Friday where we will talk more about Forex. I will also show you real trading. Let's see what will happen with my trade on oil and my trade on American dollar to Swiss franc and my trade on Australian dollar to Japanese yen. Let's see where those trades will be on Friday. And thanks for attending this webinar. I wish you all the best and see you on Friday.